Good evening and thanks for watching. Today I'm working more on my stock market tool. I'm getting ready to start paper trading tomorrow morning, and I'm doing the final preparations before I get all of that ready. So um, let's start by, I'm just going to kind of go over the project, my goals for the project, what I've done recently, and then what I'm going to be working on today. So if you're interested in this sort of thing, I work on this every day. Basically, my goal is to build up several strategies which have low correlation to each other, work well in the stock market, and basically get high returns year over year while keeping volatility and risk low. So this is the outline for the strategy. I have two goals. So the first goal, like I said, basically getting high returns. I want to do 3 to 4 times better than the S&P average. The S&P average is 6% per year. So I want to get 18 to 24% per year. But it should be market neutral. So it should work regardless of whether we're in a bull market or a bear market. I should reliably be able to return money. Now here at the bottom is the outline for the strategy. So I'm starting with stock data. I have all data going back to 2011 for everything that's been in the stock market during that time. You don't want to use all of that, so I'm kind of using some methods to filter down the universe. Once I have that universe, I'm feeding that into a returns model in addition to some features and the target for the model. The features are basically technical indicator features on price data. I have daily price data. And then we're feeding that into the and the returns model, the target should be something like returns for the day, Sharpe ratio for the day, one of those over the next 5 days, returns relative to market, something like that. And then once you have a good returns model, the final step is to implement the portfolio strategy. The portfolio strategy is basically taking the output of the returns model and saying, okay, here's how we're going to allocate capital. So I got a good model about close to 2 months ago now, and I've been working on portfolio strategies to incorporate this model, and I've gotten a lot of different things. And basically, what I was doing earlier today is trying different volatility scaling. I found previously that the only coefficient which really works well at scaling volatility, at scaling the portfolio exposure, is volatility. And so I'm looking at that here. Now I have something pulled up, but I don't remember exactly what it is. I don't know. There's two plots, so let's get out of that one. And then where should this be? Where did I put my Dr. Pepper? Oh. Alright, so that one's still going. This one's completed. So this is the current one that's running. 21% drawdown, that looks pretty good. Oh, so that's 22% target volatility. 3-day volatility look back. Oh, and this is the blue line here was the initial value I was using to scale the volatility. And so that's the rolling simple volatility. And you see, that's extremely noisy. So when I'm scaling the portfolio with that, I get a lot of noise in the portfolio scaling. You can see these red and blue lines are a bit more even. And I've chosen the red line, Yang-Chang formulation, instead of the EWMA. because you see the EWMA in this early regime is significantly lower. It's like hovering around 20 some odd percent, maybe up to like 30%, probably like 25%. This is the average. And here the average is high 30s, so maybe 38% or so. And then if you look at the average over here, the red and green are very close now. And the red average is, I don't know, maybe zero point 0.4, so not too different. But the green average is somewhere like here, so 0.35. So that's significantly different. So basically, what that means is if I'm using one scalar to scale down, if I'm using the green one, um, if you kind of have to you have to basically make a decision. You could set the scalar up here around zero point 0.4, and then you'll get around 40% volatility over here. But if we're asking for 40% volatility on this earlier regime, then it's basically not going to scale down at all. So the trade-off, if we're using the EWMA volatility estimate, the trade-off is either you accept full exposure until about 2020, or you can scale down in the early time period and you have to accept extremely minimized exposure in the later regime. So I'm going with Yang Chang because this looks like one scalar kind of works over the whole thing. So this is all sorts of things I was going to do. I'll fill that out later, but so the first thing I could do is obviously just optimize Yang Chang. And these are the strategies I want to go live with paper trading. So I'm going to start with just incorporating one of them. Maybe I could do two, but I really don't want to start paper trading on too much. I just want to get some models going. So these are the models I'm looking at. So I don't even know if I want this anymore. I think I'm going to go ahead with the simple Yang Chang scaling. So let's play around with this, because if we have... Yeah, I'm going to have to do the same thing that I did here. So let's say we could just actually just copy this. Copy, paste. No. We can't copy a whole, oh yeah, there we go. Copy to this book. Create a copy. And we're going to call this Yang Chang. All right, now let's get rid of this data. And we don't want the same distance lookbacks, but we do want okay, so we do have a 5-day look back. Oh, but we also need to change the number of positions. So actually we can document the other optimization later. But let's set up an optimization right now for this Yang Chang scaling. So optimize HRP strategy. So let it find the correct number of positions, correct HRP lookback, buffer multiplier, smooth predictions, sizing method, target volatility. Okay, so let's ask for suggestions on this. And now we should be suggesting something between 0.05 and 0.5, step at 0.05, volatility look back between 5 and 60 days. So the first most simple strategy I could implement is just 4 longs and shorts. So let's go to that other PowerPoint. So let's call this 2026. 5, 25, 2026. Model 1 for paper trading on 5/25/2026. And let's just put in the scaling parameters, because this is very simple. We're not using any scaling. So scale equals 0. Volatility type doesn't matter anymore. Sizing method beta neutral, buffer multiplier 1.5, smooth predictions, HRP look back 150, rebalance every day, hold for 5 days. So that should run this. So no scaling whatsoever. Let's start paper trading that as a first strategy. So maybe I'll at least try one unscaled strategy with this. And then I'll try some, whatever Yang Chang gives the lowest drawdown. And yeah. Oh, so what? I keep forgetting what I'm doing here. I mean, that looks really good. Sharp ratio's under 1 though, but that's probably because these early times. Even then, we get a nice upward march. Double our money in 7 years. That's not very good. But look at this region. 2022 onwards. And look at this rolling Sharp ratio here. It's almost never dropping below 0. And exposure is coming down a fair bit. Why are there so many things running? This must be the unscaled strategy. Yeah, okay. Enormous return. But, you know, even the drawdowns aren't so bad. We're always getting bad drawdowns in that COVID recovery. Yeah, that's not even so bad. What's the... Yeah, drawdown duration, 418 days. I'm not even sure if I'm going to really improve on this much. And this is robust because there's no scaling. It's just all first principle stuff. So this is a good first model to start paper trading on. Okay, so... Oh no, did I delete? Oh, good. Yeah, so we have that. Let's put this in. Let's put the result. Okay, I need to listen to some music. Where did I put my headphones though? Oh, I think they're in the car. Alright. Alright, I'm gonna run out to the car and grab my headphones. I'll be right back. Ooh. Okay, I'm back. So let me put on some music really quick. Then I'll get down to it. So this is the first model I'm going to paper trade. I think I'm going to just optimize a second model. I'm going to try automated optimization and a manual optimization, and I'm going to see how those do. All right, so what are the three things we're doing? Simple strategy, no scaling. Manually optimized Yang-Chang volatility scaling, then optimized automated optimizations with Yang-Chang. So let's run the Yang-Chang optimization. Let's set that up. So target volatility could be anything. Use drawdown scaling false. Set use IC scaling to false. Set spread scaling to false. Run the back test. So volatility threshold 0.05 to 0.5. So what if we just do 0.03 to 0.42 steps of 0.03? 0.42. Let's do 0.51. And then what's the value we're optimizing to? Return score. Score equals Sharp times 1 plus max drawdown. Optimize the fraction of capital allocated. So So I need to make sure the correct parameters are passed, and also that the name of the objective type is valid. So false, false. Oh. Oh, wait, hold up. So if we're not using these scalings, then it's setting them automatically. So yeah, how do I account for that? All right. Okay, so this one is, what did I call it? Optimize HRP3. So it's the same thing, but now we pass in objective type and objective params. But then use IC scaling is false. So if use IC scaling, guess it. Otherwise, use these hard set parameters. So I need to figure out which hard set parameters make it so there's no scaling for these. So let's set target volatility to 100. I don't know. That stuff's fine. No drawdown. IC scaling. Oh, wait, hold up. Use IC scaling. Use spread scaling. Use spread scaling. Oh, okay. Never mind. That's not a problem. So let's set the cost BPS to 15. And then we're going to optimize to the Sortino. If I'm optimizing to Sortino, what is a good floor to use for the CAGR? If optimize, oh yeah, I'll just ask that. So let's do CAGR. I'll just optimize to that. So let's go back here. Optimize HRP3 from 2016 through 2022. Let's go to the beginning of 23. Then we could test on 3, 4, 5, yeah. And 6. Basically half of 6 now. Alright, then we want to say train start, train end trials, objective type. Alright, so let's say objective type is equal to alright, so let's objective CAGR, objective params is equal to a dictionary, and we want to say max drawdown is 20. Sharp to Sortino ratio. I guess I'll do Sortino. And then we want min CAGR instead. Okay, so let's require at least 20% returns. At least, let's go at least 12% returns. So it has to at least double the S&P. And, all right, so the Sortino ratio I should get above 1. All right, so 20-day look back, 10-day look back, 30 days. So let's start with just the 5-day look back. So did I even do that? Yeah, I didn't put the results in. So that's okay. Let's start with up here we'll put 3-day look back. Let's start out comparing 3 and 5-day look back. So 3-day look back, we already have that optimization going, so turn that off, turn this guy on. And then change the volatility type to Yang Chang. Set scaling parameters. Let's set target volatility to, let's walk 0.2, 0.3, 0.4. 0.2, 3-day look back. All right, so set this window to 3. And then let's just try 0.1. That'll be okay. 0.1, 0.2, 0.3, 0.4. 4 data points for each. So let's turn the, oh yeah, that's on. Best trial 0. So that means that it wasn't able to achieve 12% returns on that trial. Same thing here. Let's just look for one more, see how it does. And then I'll check back in once it's around 20. Now, why does it say enabled? That prints every time they're set. Come on, run it. There we go. We got a value. Okay, good. All right, so model for paper trading. All right, so 3-day look back varying. Wait, did I not run that? We have the optimization going here, nothing here, nothing here, nothing here. Oh, I didn't run it. That's why it's taking so long. All right, so let's pull the data now. We need to pull the data from Friday to do the paper trading for tomorrow. Okay, so here's the results. Low return, but nice smooth curve. But the drawdown's never worse than 10%. But look at the exposure. Very low exposure. So what did I set this to? Well, that is 0.1. All right, cool. See where the optimization's at. So it's improving. It's only on trial 10. 0.79, that's pretty good. Okay, so that's a model that got trained. This is optimization. That's some portfolio strategy. Running optimization. So it is this. 1.17 Sharp. So good Sharp. Much lower annual return though. 9.79. Okay, so that's with 0.1. Let's try 0.2 now. Okay, so let's put this info in. So 3-day look back, volatility threshold of 0.1, 0.2, 0.3, and 0.4. So 0.1, we get a max drawdown of 10.23%. We get an annual return of 9.79. We get a Sharp ratio of 1.1739. And then drawdown duration, 414 days. That's not so bad. All right, so now it's running 0.2. Okay, so I'm manually documenting this. Let's go finish pulling the data. So dolt pull. Okay, so this is getting the most recent data from Friday. Okay, here's the volatility. Oh, we get up to 10x returns. This looks pretty good. Good, it got above 1, and it's only on trial 15, so that looks good. Did we change the target? 0.2, let's change it up to 0.3. Wait, 7 positions. What the fuck? Oh, okay, here we go. Max drawdown 19.69. Annual return 19.94. Sharp 1.1997. Drawdown duration 419 days. So it's not significantly worse for the duration. How was the exposure there? Exposure was still quite low, but it hovered around 0.4 to 0.5. Here it was hovering around 0.2 to 0.3. So if we set the target to 30%, okay, so now let's pull that data into my folder here. Hey, Siddharth, what's your CAGR? 10x in 10 years. I don't know. I'm showing a lot of different plots. It's It varies pretty wildly based on the. Yeah, this one was 10x in 12 years. This one was 3x in 12 years. Okay, we're getting the data. And then what about for live strategy? Scripts, live strategy, original live strategy. Okay, so let's get rid of this so it will do for today's date, not yesterday. Yo, what? Falling for a bit, very keen on trying your strategy. Good, well, I'll start paper trading tomorrow. So while I'm paper trading, I'm going to be posting all of the model predictions. So basically, we'll see how it performs over a month. And I'm trying to get more advanced strategies, but I'm at least going to start paper trading with this strategy here. No scaling, just longs, just 4 longs, 4 shorts. And this gives obviously an enormous return, but there's really high drawdowns too. So I'm not sure if this is something I'm going to be able to stomach. So it would be a lot easier to stomach something like, obviously, this one top left. Worst drawdowns under 10%. Cool, no problem. But the Sharpe ratio actually isn't too bad, but it's just that the annual return's capped at 10%. I want higher returns than 10%. Oh, I need to put that in. What happened? Oh, so now this is setting up data. Okay, so this is what we want to screenshot. Oh yeah, well I'll be I have to make a video for that, and so that's just kind of taking some time, but I'm slowly working on that. I'm making a video. I really don't like making videos. All the video editing and stuff, I don't enjoy that. I like live streams I like because it's so easy. You just change the title and then start working. Shorts are easy, you just clip them from the live streams. But making a video, you need a whole thesis for the video. I'll post the video, and always after I post the video, there's things I'm thinking I could change. Yeah, so I don't know. Okay, so let's get the universe now. Oh, the PowerPoint. Well, I don't want to show the PowerPoint because that basically has all of my research, which is my edge. They say you don't want to share your edge. So I'm sharing the code, I'm sharing the model, but I don't want to share the PowerPoint. No, target volatility is it's the threshold where it starts to scale. So say the target volatility is at 20%, and the portfolio volatility is at 15%, then the portfolio is going to have full exposure. If the target volatility is at 20% and the portfolio volatility is at 25%, then it's going to scale down slightly. It's basically an S curve. So it starts scaling down. If the goal is 20% and the volatility is up at 60%, it's going to scale it way down to like 0.2 or something, 20% exposure. So that's basically the logic for that. Now this guy's still running. Well, don't be sad. Just watch the live stream. Honestly, if you tune into the live stream, you could get the idea of what I'm doing. And I show the PowerPoint every live stream. You could literally, there's live streams where I skim through the whole PowerPoint, so you can just very slowly go through the video and see the whole PowerPoint. I literally did that. It was either this morning, yesterday, or 2 days ago. One of those streams, I went through the whole PowerPoint. All right, so this is with 30% volatility target. Worst drawdown now is still only around 25%. So I might try a strategy with some mild scaling. No, not the code's all on GitHub, but the PowerPoint isn't on GitHub. But the idea with the code is you can get the code and make your own models for yourself. The same way I'm making the models. And you can, in under 100 lines of code, you can do everything that I'm doing. Oh, see, now we're starting to get a longer drawdown duration, so that's problematic. But much higher returns. Yeah, the returns and the drawdown almost go together. All right, so now let's set the target to 40%. Oh yeah, all the code, just not the PowerPoint. Thanks. Yeah, the Sharpe ratio is good. Yeah, 1.21. So I can improve the Sharpe ratio by accepting larger drawdowns. I don't know if that's so great, but annual return 29.93. Sharpe 1.21. Drawdown duration 560 days. So the duration's starting to get longer. So let's make this the 5-day look back. So let's see if the win rate's changing at all. Okay, I ran the Universe Explorer. So this is accepting 40% volatility. So it's not really scaling down at all. One point 1.13, 1.19, 1.13. Oh, so that's even higher. So 30% target, we get a higher Sharpe ratio. Max drawdown of only 28%. Oh, let's just do the same thing with 5 days. Then we should get some idea of what's better. Do I have everything here? Yep. So let's go to 5-day look back with 0.4 and see how it does. All right, max drawdown 32.55. Annual return 37.11. Sharpe 1.245. And drawdown duration 418 days. Wait, what? So the drawdown duration went back to 418. Yeah, so this is looking like no exposure scaling would be good. Hey, Global. Yeah, everything's good here. How are you? I'm going to go grab a Diet Dr. Pepper real quick. I'll be right back. Okay, so this is 40% 5-day look back. Alright, so let's see how this does. I guess we have the results right here. Let's just throw it in. So 0.1, 0.2, 0.3, 0.4, and max drawdown 32.55. So same exact thing. Annual return 37.11. Sharp 1.24. Huh. Did I change anything? Yeah, that's 5 days. Drawdown, return. Drawdown, return, sharp duration. Drawdown, return, sharp duration. Okay, good. So I can just put those guys in. Okay, so sharp's going up with the exposure scaling. Annual returns going up. Max drawdown's going up. Drawdown duration is almost flat. So what should I try next? So 0.25 will get some good shape here. 0.25 and 0.35 we probably want to do. Let's start out doing 0.35. Let's look at the optimization. Still at 1.05, so we're not getting much improvement now. Have you analyzed your losing trades? No, there's so many trades. I mean, it's entering 8 trades. This is 4 long, 4 short. So with these strategies specifically, I'm entering 8 trades every day, 252 days a year. So what is that, 2,000 trades per year? So yeah, I'm not analyzing them at all. But that would be good. That's kind of the next step. Just get some distribution on, how do the trades I take look. Okay, here's the result with the 35% threshold. 35% target, I should say. All right, so with 0.25, oh, we don't have anything yet. This is 0.35. Max drawdown, 30.59. Annual return, 34.14. Sharp, 1.2234. Drawdown duration, 560 days. Okay, so let's see where this falls in the data. So drawdown 23.94. Annual return 25.06. Sharp 1.2042. Drawdown duration 559 days. Annual return's almost linear. So I don't know, 0.15 maybe? That would be interesting basically for just the Sharp. What even do I make of this? I don't think there's some optimized location. I think the conclusion to make is that I mean the unscaled strategy is giving high volatility. It'd be good to have this point in here. Is this high too? Because if the Sharp, yeah, I don't know. Maybe I'll try 0.05 next. But doesn't. Have you analyzed your. Got a $75 withdrawal from the prop firm, first payout, but it was from 3 weeks of neural net rolling with a 10K account. Not the best. Wait, so what does that mean? They have those prop trading competitions? Is that what you did? No, but I haven't looked at the most losing strategies. I'm just discarding them if they're bad. That looks really good. It's improving. Very slightly improving. 15% drawdown. 15% returns, 1.19 Sharp. Let's look at the exposure. What is this, 25%? We're getting pretty good exposure here. Exposure is much better with 35%. So 35 or 30%, if we go with one of those, what do we get? We get high drawdown. 35 or 30, same drawdown duration, 35 or 30. 35 gives a higher return, higher Sharp too. Okay, so let's see if we see any movement in these lines. Drawdown 15.05. Right on. Return 14.86. Should still be linear. Yep. Sharp 1.1925. Drawdown duration 418 days. %. You have to pass 2 phases first time. You do 10% profit phase. Phase 2, you have to do 5% of the account with limited drawdown of 5% a day maximum. Wait, what's that mean? 10% profit? Like you're supposed to get 10% profit? Well, congratulations. So they gave you your money back you paid to get in, and then they give you $75 on top of that? Not bad. Hey, that's not bad. So you had a $10,000 account, you made 1%, and they paid out you got 80% of that. Nice. Everyone congratulate Global. That's a grand achievement. You made money from clicking buttons. All of us, that's our dream. Make money from clicking buttons. Yeah, you didn't, no clicks even required. Even better then. Anyway, congratulations. That's a good achievement. Um, so let's pick a couple of different strategies because if we do point one, we will get a 10% drawdown. Um, so unscaled 2. That's what I don't understand. So it goes up. I don't understand these at all. All right, so let's get the live strategy ready. I'm not sure if I'll get all of these, although these are pretty simple strategies. They should be simple to implement. And actually, I don't need to change around live strategy at all. So let's try, yo, what the hell? This is off by 10 years. Okay, so then we get the universe, we get raw data. Let's go 4 longs, 4 shorts. Sizing method is dollar neutral. So let's change sizing method to beta neutral. HRP look back, 150 days. All right, let's make sure we have the most recent data. Six, 5, 4, 3. Good. So it has May 22nd, which was Friday. All right, so total capital 3,000. Four longs, four shorts, beta neutral. Smooth predictions is on. Rebalance every day, hold for 5 days. Use dynamic scaling is false. Let's set this to false. And then this will give us predictions for the unscaled portfolio. Alright, so let's go to scripts. So this is on model 28, trained through end of 2025. This one also is unscaled. Okay, so I'm going to call this, what is the naming convention I used? So 28 underscore 2025 underscore unscaled 4 positions. 28 2025 unscaled 4 longs slash shorts. That's it, right? So AXTI. So I wouldn't be able to execute those short positions. So maybe I'll just do this on a $10,000 portfolio. Maybe the portfolio's less. Paper trading. Move that guy to trash. And let's run this again. All right. Let's see, how does this do? Okay, so if I have a $10,000 portfolio, I can actually execute. All right, so this one is not unscaled. Instead, it's 28 underscore 2025. Simple YZ. TV equals what did I say I was going to do? I'm going to do 25%. So if I want a return of 25%, a drawdown of 25%, I should use 0.25. Yeah, so drawdown returns. All right, so TV equals 25. 10%. So target volatility is just 25% now. So let's change this. Use dynamic scaling is true. Now let's use Yang Chang. Target volatility is 0.1. Oh, let's do 0.25 first. Volatility look back is 3 days. Drawdowns off. These guys are off. Account history thing. I really need to clean up this file and make it work better, because this is going to drive me nuts deleting this every day. So I think the assets should be the same. Oh yeah. So same assets, just the positions are different, but it's really just the same picks, just scaled down or up. So let's set it to 10% now, and then we will be done with our predictions for tomorrow. All right, so we have our predictions. Um, yeah, we basically just have to track it tomorrow. So tomorrow, what I'm gonna do, or I guess it's really today now, before the market opens, or really I'm gonna around the time the market opens, I'm gonna get the open prices for all of these assets I want to buy, and then also try to simulate what would be the open price if I went and tried to buy this right now. And then that way I can kind of compare the results of the two, and we should get an idea for slippage that's happening. But so we have these strategies. The left strategy is unscaled. So this is the riskiest. It will give high drawdowns of like up to, what's the worst drawdown we got here? Um, so we could get drawdowns up to Ying Chang. The fuck? I guess I put it in here. Oh, I never put in the unscaled. Oh, here it is. Yeah, so we're gonna have to tolerate like 35% drawdown. So that's pretty extreme. However, if we're willing to tolerate that, the returns are really high. The average annual return's 40%. So If I could tolerate 35% drawdowns, it'll give 40% annual returns. Now, that's the strategy at the far left. I'm gonna have to tolerate high drawdowns, but I'll get much higher returns. The middle strategy is using 25% target volatility. So I'm targeting 25% as my worst drawdown, and 25% profit, because those are scaling basically linearly. Here I'm targeting, so this one's kind of like a personal portfolio. It's not as risky as this unscaled one, but I'm still taking in a fair amount of risk. I'm tolerating a 25% drawdown to get 25% returns. And here I should only be getting 10% returns. However, the worst drawdown should be like 10%. So these are the three strategies I'm moving forward with. And we'll start tracking them when the market opens in about 6 hours to see how it does. But that's it for now. If you're interested in this project, if you want to see how the paper trading goes, be sure to subscribe. Go to the GitHub, try out the code, let me know how it goes, let me know how I can improve it. And of course, if you find it useful, please star the repository, watch the repository, and follow me on GitHub. And that's it for tonight. Tune in about 6 hours to see me start paper trading. Thanks. Have a good rest of your night. Adios.